4 undervalued REITs that investors are buying and 1 REIT that they are selling. We're going to take a look at each of these REITs' historical performance. We're going to dive into their dividend safety. We're going to take a look at some of their financial metrics. And as always, we will run them through the valuation model to get to the intrinsic value as well as our acceptable buy price given our investor margin of safety. And we'll look towards Wall Street to see what they're forecasting over the next 12 months. Jumping into the first undervalued REIT that investors are buying, it is Stag Industrial. Now, over the last year, this is up 11%, and over the last 10 years, if you held this, you would be up 65%. Now, bear in mind, this doesn't include those dividends reinvested, and Stag Industrial does pay every month, similar to Realty Income. We can also see its all-time high, December 2021, at around $48, and it currently trades towards the upper end of the 52-week range, with a yield of just under 4% and a P to FFO forward of 16.08. In terms of dividend safety, we're looking at a score of 60. It is borderline safe. Market cap, $7 billion, a mid-cap company. Now, in terms of those recessionary metrics, in the last recession, 07-09, they didn't pay a dividend, so no comparative data. In terms of growth, they had negative 12% recession sales, which was pretty much in line with the S&P's average growth for that period. Dividend growth, not the greatest. We can see a below inflationary increase of 0.7% in January this year. Typically on the channel, we want to see 4% or more just to keep up in line with inflation. Over the last 5 years and over the last 10 years, it has been lacking that inflationary increase. We do note, however, they have been increasing those dividends for the last 12 years. Now, in terms of dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average. Currently 3.85 versus 4.43, so you could value or essentially argue some signs of overvaluation, but do bear in mind we don't conclude until the end of the episode. Forward P to AFFO as well, 18.7, sitting slightly higher than the 5-year average of 17.4. But as always, we're not looking at these models in isolation. And when we compare it to the real estate sector P to AFFO of 13.6, Stag Industrial does sit a bit higher. So let's jump into their financial metrics. Now, typically on the channel, we do like to look at the free cash flow payout. However, for REITs, a lot more volatile. So we draw your attention to the adjusted FFO, funds from operation. For industrial REITs, we're targeting below 75%. Now for Stag Industrial, unfortunately, it has been above that 75% consistently. But in more positive news, in the latest year, it was 73%, so it was below that. And 2024, they are expecting to edge a little bit lower to 72%. So far, based on the information over the last few years and the expected range, that dividend does look to be safe. Now, when we take a look at the adjusted funds from operation per share, we can see it has been increasing over the last 10 years. Now, what I do want to point out, it hasn't been very consistent. We're going to take a look now at the percentage, but over the longer term, it is increasing, moving in the right direction. 2024 expected 206, an increase from 2 in 2023. Double digits looking very strong in 2021, bouncing back, and over the last 2 years at 7%. This is still fairly healthy. 2024, though, noted to drop down to around 4%. Sales growth for REITs, what we want to see, steady moderate growth, 5 to 10%. What I would point out here, over the larger term, it has been double-digit increases to their top-line sales, but we do note it has been trending downwards with the latest year at 8%. Now, I would like to see this as a one-off and see it back into the double digits. Nonetheless, though, 8% isn't too bad itself. Shares outstanding, I do want to draw your attention to the fact that essentially with REITs, this is very typical. You do see the opposite. They do dilute your position over the longer term. The reason for this, well, they do issue equity to fund property acquisitions as they retain a little of that internally generated cash flow, given the fact they pay the majority of this as dividends. Speaking of shares outstanding and share buybacks, just to let you know that we do have a free weekly newsletter that does get sent out every Friday on the channel. If you want to subscribe completely free, click on that pinned comment below. Our latest copy was on share buybacks, looking at companies that aggressively do share buybacks, which is a very, very strong bonus for investors. Moving on then, so we can see numerically their sales has gone from 174 million in 2014 to 708 in 2023. ROIC, now this is one of my 7 golden dividend metrics. One of the newsletters I do run through all 7 to find undervalued companies. What I want to see for typical companies, 10% or more. For REITs, 3 to 5%. That gives me faith that management are able to effectively allocate their capital. What's nice to note, it has been increasing over the longer term, 4% in 2023. That does give me a lot of faith that it is increasing and it is a healthy target in between our 3 to 5% range. Operating margin, very strong in 2023 at 34%. On top of that, what we note here that it has been increasing, which essentially shows us the operational efficiency of the business is improving year on year. Very positive to see for this industrial company. Finally, the net debt to EBITDA, one of the most important metrics. EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things. One, the dividend safety, and two, the balance sheet strength. For industrial REITs, we want to see below 5. Now, what this number shows us is the number of years it will take the company to pay off all of their debt net of cash on hand. 2022, pretty much there or thereabouts at 5.04. The latest year, 4.97, looking pretty strong. It has been decreasing over the longer term. 2024 expected to go lower at 4.66. So what I'd like to see about Stag Industrial, why there are some metrics that I do question, such as the dividend growth, overall, over the longer term, it has been improving its efficiency. Now let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. On the channel, we typically do deep dives of companies running through all 4 of our models. What we're going to do in today's episode is jump straight into the intrinsic value. And for today, Stag Industrial's intrinsic value is coming to $42, the average of the 3 model prices. Now, the current price sits around $38.42. Typically, we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. For Stag Industrial, we see it's around 32 cents difference, so we see around a 10% margin of safety based on our estimates and judgments. In terms of Wall Street and their forecasts over the next 12 months, well, they see a price target of $40 with upside of 4%. And I do want to just remind you that similar to Realty Income, Stag Industrial does pay those dividends every single month. Before we move on to the next company, just drop your thoughts in the comments below as you go along whether you too have been adding or selling any of these REITs. We then move on to the next undervalued REIT that investors have been buying, American Tower Corporation. Now, it is down 9% over the last year. Over the last 10 years, however, up 130%. And we can see all-time highs sitting around summer 21 at $300. Currently trades in the midpoint of the 52-week range with a forward yield of 3.6% and a P to FFO forward looking of 18.3. Dividend safety 78, it is safe. Market cap 90 billion or thereabouts, so a large cap company. And when we focus on those key recessionary metrics, well, they didn't pay a dividend. However, they had plus 8%, so very strong, above the average growth. Remember, that was negative 12%. And they also outperformed the S&P with their negative 37% return. Dividend growth, lots to love here. Double digits over the last full year, double digits over the last 5 years, and on average, over the last 10 years, you would be getting an increase of 21% year on year. They have also been increasing those dividends for the last 10 years. So let's take a look at dividend yield theory. We can see here a very strong and severe sign of undervaluation. The yield sits at 3.63, above the 5-year average of 2.05, and the forward P to AFFO 18.7, above that 5-year average of 25.4, or below in fact, so that is also a sign of undervaluation. We do note, however, the real estate sector P to FO is much lower at 13.6. So let's take a look at the adjusted funds from operation. Now, yes, below 90% is our target, and it is very nice to see 63% in 2023. Expected 68% in 2024. Now, I know it has been increasing over the last 10 years. It isn't necessarily a red flag indicator, but just something to keep an eye on given the fact that 90% is the maximum we like to see. Adjusted funds from operation, nice to note, it has essentially more than doubled over the last 10 years, 1010 in 2022, expected to be flat in both 23 and 24, so something just to consider. And when we take a look at the adjusted funds from per share growth on percentage, we do see very, very inconsistent, although inconsistent in a positive way. We see strong double digits from 2013 to 2018, a drop in 2019 before we see here 2022 7%, followed by a 3% expected increase in 23 and expected, as we mentioned, flat into 2024. So sales growth, as we can see here, looking very strong, pretty much double digits nearly every single year. 2021, 2022, no different, although we do see 23 annual report once released is expected to show a 6% increase to their top line. Shares outstanding, I love to see this. For a REIT that are very typical to dilute your position, whilst they have increased it from 399 to 467, it isn't as fast as other REITs that we will look at today, as well as we have reviewed on the channel. Top line then essentially tripled from 3.36 billion in 2013 to 11.1 expected in 2023. Taking a look at that ROIC, again, very nice. In fact, above the 3 to 5% minimums we want to see, 6% expected in 2023. So a lot of positive metrics with American Tower Corporation. Operating margin, fairly consistent, I would say, around that 38% year on year, although we do note it did drop in 2022, but rebounded positively back into the 30s in 2023. Finally, the net debt to EBITDA, 5.17 in 2023, so for the majority of REITs, below 5.5. 2024 expected the same, so no real red flag indicators so far based on this. So let's jump into the valuation of American Tower Corporation. And don't forget, you can grab a copy of this valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment. So we start off with a margin of safety of 10%, a buy up to 202, 15% up to 190, 20% not quite there yet. So right now for American Tower Corp, we see around a 15% margin of safety. What did Wall Street say? Well, they have a price target of $237. They see upside of 26%, so they do see this as a very, very strong buy. And as always, let me know whether you have been adding American Tower Corp or if you added it when it was even lower towards its 52-week low in the mid-150s. We then move on to another undervalued REIT that we are reviewing for the first time on the channel, Innovative Industrial Properties, up around 7% over the last year. We can see over the last 10 years, it has gone from around $17 and it did in fact peak all the way to $280 before falling back down to the current value of $90. Right now though, in the 52-week range, it is in the mid to upper end. It does offer a very strong yield of just over 8% and a forward P to FFO of 11.04. Dividend safety, however, it is unsafe by this score of 40. We'll touch upon that as well. 2.5 billion, a mid-cap company. So when we take a look at the dividend growth, well, the latest increase just from a few months ago, 1.1%, very poor, below that inflation that we always advocate on the channel. However, the last 5 years, on average, very, very fast at 67%, and they have been increasing those dividends for the last 5 years. So let's take a look at dividend yield theory. We can see that sign of undervaluation, although you could argue, given how higher it is than the 5-year average, it could appear to be speculative, 8 versus 4. But we do also note the forward P to FFO significantly lower than the 5-year average of 18.1. But interestingly, real estate sector P to FFO is slightly higher. So let's take a look at their payout. As we mentioned, for industrial REITs below 75%, like we saw with Stag REIT. But we do note for IIPR, we do see it above that 75% consistently. 81 in 2023, 82 expected in 2024. Not the worst, it is still in the low 80s, but something just to keep an eye on moving forwards. Adjusted funds from operation, well, it went from negative 62 cents in 2016, 8.45 in 2022, 8.92 expected in 23, and looking to be fairly flat from 2024's movement to 23. In terms of percentage, we do see it have a very strong jump in 2018 and 2019. One could argue that the growth has started to slow down, but again, just something to take a look at when management do guide for 2024 and 2025. And as we can see, 2024 is expected to be a decrease of negative 1%. In terms of the top line growth though, we do see some incredible growth in 2017 and the years after as well. 2022 at 35%, 2023 expected 14%, however, does show that the growth is starting to slow, but again, something we need to take a more detailed analysis to see whether or not it will bounce back to those levels that we have come to love with this company. Shares outstanding, a very rapid dilution of your shares to note, 963 to essentially 28.2 million, so something just to keep an eye on moving forwards. And we note their top line has gone from around 6 billion to 300, or in fact 6 million to 301 million. So a very, very fast-paced growth to their top line. But again, a lot of things just to keep your eye on. ROIC 7% over the last 2 years, 8% in 2023. This is very positive in my opinion as a singular metric. But as always, when we do look at our investment thesis, we do need to couple all of our information together. Operating margin over the last 6 years looking very strong, very healthy. In fact, pretty consistent as well. 57% in 2023. Lots to like about that. Net debt to EBITDA, well, 2022's 0.95. 2023's 0.78 and 2024's 0.75 is very, very strong in my opinion. That dividend does look to be safe for now based on this information, and their balance sheet does look to be secure. So let's jump into the valuation of IRPR, and as always, the intrinsic value for today's episode is the average of these models on screen, coming to $116. Now with the current value of $90, as always, we input that 10% level, we keep going until it's near the current trading price, and we can see over 20% margin of safety currently on a company which also has a yield of over 8%. What do Wall Street forecast? Well, they have a price target of $108. They see upside of 19%. So again, very similar to American Tower Corporation, they do see this as a strong buy. We then move on to another REIT that is undervalued than investors have been buying. It is ESS, Essex Property Trust, up 1% over the last year, up 40% over the last 10 years, but we do see its all-time highs around $354 at the beginning of 2022. It does currently trade, however, in the mid to upper end of the 52-week range with a yield just under 4% and a P to FFO of the mid-15s. In terms of dividend safety, well, we have our first very safe score today at 93, 15 billion market cap. It is a large cap company. In terms of the key metrics, well, they increased the dividend during the last recession above average growth. However, they had a near S&P return with a negative 53%. Dividend growth, well, they increased it last February above inflation at 5%, so we are expecting an increase over the next few days. Inflationary increase over the last 5 years and 6% over the last 20 years, looking very healthy. In terms of dividend growth streak, well, they are a dividend aristocrat. They have increased those dividends for 25 years or more. In terms of dividend yield theory, well, we can see a double sign of undervaluation, 3.95 on the yield versus that 3.25 year average. Forward P to FFO, 17.7 versus the 5-year average of 21.5. And we do note, though, it is slightly higher than that real estate figure. In terms of their payout ratio, what we can see here, 2023 68%, 2024 expected 70%, pretty consistent in the mid-60s. It is expected to touch 70%, but still lower than that 90%. So no worries with Essex Property Trust's payout ratio. FFO per share was $7.86, essentially doubled over the last 10 years, $13.50 in 2023. Not very consistent, but overall moving in the right direction. Expected a small drop into 2024. So percentage-wise, how does that look? Again, pretty inconsistent. We see some strong numbers in 2014 to 2016, again replicated in 2022, and a slowdown in 2023. But over the longer term, on average, it does look very healthy. In terms of their sales growth, for those that wanted to see the percentage, well, again, from the last few years, it isn't looking the greatest. We see 2 years of negative 1%, 2022 at 5%, and again, both 2023 at negative, or in fact, just a positive 1%, is a little bit of a cause of concern and something I would take a look at management's guidance. And if we do a deep dive, this is something we will definitely cover. Shares outstanding, though, they don't typically dilute your position that fast. In fact, not that much. It has gone from 56.7 million to 64.3. And we can see their total sales has gone up by 65% over the last 10 years, from 1 billion to 1.65. Now, in terms of the ROIC, very, very consistently at that 4% over the longer term. Nothing wrong there at all. Remember, we are looking for at least 3 to 5% consistently. Operating margin, again, pretty consistently around the 30%, 30% in 2023, 32% over the last few years before that as well. So looking positive in terms of their operational efficiencies. Net debt to EBITDA, it looks like it has been decreasing over the longer term. We do see that 5.77 is above our 5.5, but we can take some solace in the fact that 2024 is expected to drop down to 5.07, below that 5.5 maximum barrier we like to see for REITs. In terms of the valuation then, let's jump in and see whether or not we see this as a large margin of safety. The intrinsic value at $266, and as always we start off with that 10%. We can see it is a buy up to 239. At 15%, not quite there yet. So for Essex Property Trust, we see a 10 to 15% margin of safety. What about Wall Street? Well, they see a price target of $251. They see upside of 7%. So again, they do see this as a buy, but with not the greatest upside in comparison to some of the others we have reviewed today. We then move on to a REIT that a lot of investors have been selling, and it is WPC Carey. Now, it doesn't necessarily mean it isn't undervalued or isn't a buy now, so that is what we will take a look at today. It is down 30% over the last year. Over the last 10 years, however, down 9%, and we can see its all-time highs quite a while ago, October 2019, at around $92. It's trading towards the lower end of the 52-week range with a yield of over 6% and a P to FFO of around 12. Dividend safety score then sits at 70. It is safe. Market cap 12.4 billion, a large cap company. When we take a look at those recessionary metrics, while they increased the dividend during the last recession, they had below average growth, yet they outperformed the S&P with their negative 34% return. Dividend growth, they had that negative 20% in December 2023 after their spin-off, and we can see over the last 5 years 0%. However, over the last 20 years, it has been at least keeping up in line with inflation. So in terms of dividend yield theory, we actually have a sign of undervaluation, 6.05 versus 5.45, and again a similar story, 12.1 lower than that 5-year average of 15.1, and we can see it is slightly lower than real estate's 13.6. Now, in terms of the adjusted funds from operations payout ratio, below 90% consistently. Nice to note, 79% in 2023, expected to go much lower in 2024 at 73%. So let's take a look at the adjusted funds from operation per share. We can see that it has been increasing from 481 to 518, but the growth is lacking, as we can see, and in terms of 2024 it is expected to drop down to 470. So when we take a look at it percentage wise, we can see in fact over the last 10 years the adjusted FFO per share has been down 3 times negative wise, and 2024 is expected to go down lower. So when we take a look at the sales growth, remember 5 to 10% is our target. We see the last 2 years looking very strong, double digits, and even 2021 looking good at 8%. Numerically speaking then, 81 or 810 million sales in 2014 to 1.74 billion. Shares outstanding, they have also diluted your position, in fact more than doubling that position in 2014 to just under 100 million to 216 in their latest report. ROIC then, we see it is between that 3 to 5%, in fact a couple of years above. 5% in 2023 is nice to note for this metric in isolation. Operating margin as well in the mid 40s to the high 40s, so very healthy, 48% in their latest annual report. Finally, the net debt to EBITDA, somewhere where you could say is a little bit lacking. It is 5.48 in 2023, so around the 5.5. And we do know, however, unfortunately in 2024 it is moving the wrong way to 5.7, where we do typically like to see it lower, especially when it is already around that maximum level. So what about the valuation of WPC Carey? As we mentioned, if investors are heavily selling this stock, it doesn't necessarily mean it is undervalued or isn't a buy now. So let's take a look. So our intrinsic value is coming to $64 with the price at just under 57. We start off with that 10% margin of safety and we keep going until it's near the current trading price. So we can see it is pretty much bang on a 10% MOS based on our estimates and judgments. In terms of Wall Street and their forecasts, well, they in fact see upside of 15%, one of the highest upsides of those that we have reviewed on the channel today, with a price target of $66. As always, if you've enjoyed today's content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price and margin of safety of companies in your own portfolio or on your watch list by clicking on the pinned comment below. As always, let me know your thoughts below whether or not you do agree that a lot of these are undervalued and you have been buying, or maybe you've actually been buying the ones that investors have been selling WPC. As always, have a great day, catch you on the next episode, and take care for now.